Welcome to the Candlestick Forum training program on bearish engulfing signals. My name is Steve Bigelow. I've been investing for a little over 35 years and by accident came across candlesticks approximately 25 years ago. Since then, I have published 3 books on candlestick analysis. What I have discovered during that time frame is that over the 50 or 60 candlestick signals in the candlestick universe, there's only 12 signals that really are appropriate for learning how to recognize major reversals in the markets. These are what I consider the 12 major signals, with the bearish engulfing signal being one of them. The criteria for being a major candlestick signal is that it occurs often enough that it becomes relevant as far as investor analysis of a market trend. Again, out of the 50 or 60 candlestick signals in the candlestick universe, there's only approximately 12 that you really need to learn. These are the signals that produce most of the trades that you'll ever want to be participating in. The bearish engulfing signal, unlike the bullish engulfing signal, is where they open it above the previous day's close and they close it below the previous day's open. The last bullish candle of that trend is completely engulfed. The body of the last candle is completely engulfed by the body of the new candle. This will usually occur when stochastics are in the overbought condition. This does not necessarily mean the body has to engulf the shadows of the previous day, just the body. After an extended uptrend, when you can see that there's been a large body that has enclosed the previous day's body, this tells you there's been a change of investor sentiment. Stochastics on our charts are when the stochastics, which we use 1233, are in the overbought condition. The overbought condition are when stochastics are above 80. The oversold condition is when stochastics go back below 20. When we see a candlestick sell signal in the overbought condition, the probabilities are extremely strong that there's going to be a reversal. This is based upon 400 years of the Japanese rice traders observing and utilizing candlestick signals that didn't make them wealthy, it made them legendarily wealthy. A bearish engulfing signal opens above the previous day's close and closes below the previous day's open, completely engulfing the body of the previous day. It also is more compelling that there's a change of investor sentiment when we see a close back below the T-line. The T-line is the 8 exponential moving average. We will be going into this more as we go through the training series. As you can see, we have very simple charts. We have the 50-day moving average, which is your dark blue. We've got the 20-day simple moving average, which is your gray. And we also have the 200-day moving average, which will be a red, much thicker red line. The reason those moving averages are on these charts are due to the fact that most of the money managers, if not all the major money managers around the world, use those moving averages to make decisions about their portfolio positioning. The advantage we have with candlestick signals is we can see exactly what's going on at those moving averages based upon a candlestick signal, telling us whether there's been a change of investor sentiment. And one of the powerful aspects of candlestick signals is that the appearance of a candlestick reversal signal is usually a high probability situation that investor sentiment has changed and the trend has changed. Note previously how there was bearish days in this up move, but these were not candlestick signals. These were just merely a pullback in an uptrend. It wasn't until we saw a bearish engulfing signal behind a couple doji indecisive trading days near the overbought condition and a close below the T-line that told us that there's now a change of investor sentiment. We were probably going lower. Another very powerful aspect of candlestick analysis is the common sense, logical aspects of entering and exiting trades. Note what happened on this chart where we had a bearish engulfing signal in the overbought condition, telling us it was probably time to go short or selling off our position. To go short, notice what happened the next day. They opened up positive, but when they came back down through the previous day's close of the bearish engulfing signal, that was more evidence that the bears were in control. This is a perfect entry level for a stock that trades higher than what we are really looking for is to confirm a downtrend. In this case, we're looking for more selling after a candlestick sell signal. Another major advantage of the bearish engulfing signal, it is the final hurrah for the bulls and the start for the bears. Note in this chart, we've had a very strong uptrend. We see a doji in the overbought condition. As we know, when we see a doji in the overbought condition, we start looking for a reversal. The next day, they took it down and brought it back up. Now you had a hammer or a hanging man signal, which we will get to further in this training. A doji and a hanging man are evidence that it's time that it might be looking for a reversal in this market. We need selling confirmation. Whenever you see a bearish engulfing signal at the end of an indecisive trading area in the overbought condition, that's the last hurrah. That tells you the bears have now finally broken down the bulls and the bears are in control starting your next downtrend. This chart is good evidence of a reversal in investor sentiment. Note the previous 4 or 5 days were indecisive trading, spinning top, shooting star, doji, a small trading star type formation, followed by a bearish engulfing signal. That bearish engulfing signal finally tells you that the bears have taken control. Then there's another bearish engulfing signal 2 days later, closing below the T-line. That was the time to start looking for a good place to enter on the shorts. As we can see in this chart, we had a nice uptrend. It started to get a little bit soggy. Try it again, got a little bit soggy. Try it again, and it was not until the bearish engulfing signal kind of eliminated or put the final nail in the casket as far as this uptrend. This is a powerful signal telling you the bears have just now taken control and the bulls are out of the way. And each signal has a rational description or a rational explanation. Notice you're in an uptrend. You got to the 50-day moving average, had some selling. It was not a sell signal. Then the next day they opened it right back up at the same level they opened it the previous day, and immediately the bears told you they were in control and then did a bearish engulfing signal. Also closed it back below the 50. And it closed it below the T-line. The T-line is a very important factor. Anything that closes below the T-line has a much higher probability that it's going to be in a downtrend versus an uptrend. Here's another illustration where the candlestick signal started showing some indecisiveness up here toward the overbought condition. The trend didn't turn until there was a bearish engulfing signal. Makes this a very simple entry strategy that if you're planning to go short, very simple. What do we want to see the next day? We want to see the bears are still there. So a lower open, especially with stochastics turning down, tells you it's time to go short. What your true confirmation will be is shorting and having it close below the T-line. As you can see, the T-line will remain a fairly confident indicator that you're in a downtrend as long as you don't see a candlestick buy signal and a close above the T-line. Another aspect for identifying a potential candlestick sell signal is anytime you get up into the overbought area, a rule of thumb is if you see it gap up, start watching for a sell signal. If it gaps open and moves higher, you can stay in it as long as it doesn't come back down through the open. Some very simple stop loss procedures are, if you see a gap up in an overbought condition and trades higher, put your stop right below the previous day's or that day's open. Rationale will be if it goes up and comes back through that level, it's going to create some sort of candlestick sell signal. On the other hand, if it opens higher and immediately starts selling off, if you have time, you put your stop at the previous day's close. If it comes down through there, you're going to have some sort of sell signal, either a dark cloud, a bearish engulfing signal. Even if it came back up at the end of the day, you'd have a hanging man signal. In this case, we can see that the uptrend was over when they gapped it up and did a bearish engulfing signal. The move from this level to this level, completely engulfing the previous day's trading, is a powerful indication the bears have taken control. As we can see, there was still some more buying afterwards, but the overall trend essentially started with that bearish engulfing signal. And the visual elements of candlestick analysis makes it relatively easy to see when support and resistance levels are taking effect. We had a strong uptrend and then a bearish engulfing signal. Where's the first target? Usually back to the T-line. The one rule of thumb in candlestick analysis is that we've discovered that when you use the T-line, the further away you move from the T-line, the higher the probability it's going to move back to that level. Makes this very simple. If you see a candlestick sell signal that's moved a little bit away from the T-line, anticipate there's going to be some profit taking. Is this the time to take profits? Definitely, because we don't know whether the profit taking is going to stop at the T-line or the next major moving average. Note that once we got down to the 50-day moving average, we had a bullish engulfing signal in the oversold area. High probability, especially when they closed it above the T-line, we were back in an uptrend. Came right back up to the same level it topped out before, gapped up. What should we be prepared for? A candlestick sell signal. Unless there's some great news where it's going to keep right on going, then you don't have to worry about a stop somewhere along in here to take profits. But the fact that they gapped it up and immediately started selling it off right at the same level they did that before is completely obvious. Anybody that's looking at a chart, knowing what the signals are, allows a candlestick investor to take advantage of that information a lot quicker. Along with this chart, we also have another signal that usually is created by a strong sell signal. Notice the magnitude of this candle, fairly big. The next day we have a doji. Now there's a simple rule for the doji, as we've learned in our doji series. They will move it in the direction of how they open it after a doji. In this case, when they open it lower, you can be shorting immediately, because a doji sandwich will have the same equivalent move to this candle as it did this candle. That's good for entry for short positions. It's also good for the day trader that wants a high probability trade. And we will reiterate, what you're going to find in these training sessions is you're going to see a lot of repeats in charts. We like to go over the same analysis or the same visual analysis, allowing investors' eyes to become accustomed to what the signal is doing. For example, here's a bearish engulfing signal, engulfed its own color body of the previous day, but it is a bearish engulfing signal. Note what type of trading was occurring up here. Indecisive, spinning tops, and then the bearish engulfing signal closing right at the T-line made for a very simple trade that if you wanted to go short, all we needed to do was see it open lower and start trading lower. That would have told us that the bearish engulfing signal is confirming and that the T-line was not acting as support anymore, that you were in a downtrend. Once again, we'll demonstrate a fairly easy entry strategy. Notice the bearish engulfing signal of this day. You're a good distance away from the T-line. Stochastics rolling over. It opens positive the next day and trades positive. However, we already know that we have a bearish engulfing signal, which is usually an indication that the trend could be changing. If it didn't confirm and opened higher and traded higher, obviously you're still in an uptrend. However, if you're ready to go short, if you just put your stop 1 penny below where it closed the previous night, if it traded higher and came back down through that level, that would be a good indication the bears are taking control and at least heading back to the T-line. More conservatively, if you saw it confirm, if it opened below the T-line the next day, then you could be going short. And simple rule of thumb, you stay short until you see a candlestick buy signal and a close above the T-line. Doji, little hanging man type signal, bearish engulfing signal. The bearish engulfing signal is the final nail to the coffin as far as telling you when the indecisive between the bulls and the bears, now they have become decisive. The bears have taken control, especially when they close it below the T-line. That tells us we're probably in a strong downtrend. Or if you have a bearish engulfing signal after indecisive trading that closes below the T-line, you can be going short immediately the next day. Even though they brought it back up a little bit, notice how they couldn't really get it above the T-line with any great magnitude starting this long downtrend. And the strength of a candlestick bearish engulfing signal is strong enough that even though you might not be in an overbought condition, it does tell you the bears are starting to take control. We had a bearish engulfing signal. They tried to take it back up again and then did a kicker signal to the downside, a very strong sell signal. So if you look at this whole conglomeration of signals in here, that bearish engulfing signal is kind of the peak, telling you that's where the bears were starting to take charge. The bearish engulfing signal becomes more compelling after seeing another signal, such as the Doji shooting star. Note what the Doji shooting star did. After a bullish harami, which told us the selling had stopped, which we'll get to in a later training, took us right up to a shooting star that just touched the 200-day moving average and started to curl the stochastics over. The next day they opened it higher. A very simple place to put your stop would have been at the previous day's open, or in this case the low of the previous day, because that would tell us that if this is a shooting star and they started trading it off, that was time to take profits. If they opened it higher and moved higher, obviously the trend was still upwards. In this case, they opened it higher and brought it back down to this level, creating selling. That told us to be out of this position. And then once it closed below the T-line, that told us we could be going short until we saw a candlestick buy signal and a close above the T-line. A simple rule of candlestick analysis is the bigger the reversal signal, the higher the probability there's been a change of investor sentiment. This example shows us that the bigger the signal, the higher the probability you're going to be in a downtrend. Also, the higher that you take this up away from the previous trading and start bringing it back, the more compelling it's going to be in a downtrend. This could be considered also a belt hold signal. A belt hold signal is when they move it away from the trading range, then bring it back into the trading range. A belt hold can be a gap up and brought back into the trading range, just into the trading range, and or a dark cloud where it closes more than halfway down this candle, or even more compelling, the sellers are in control, a bearish engulfing signal. A gap up in the overbought condition should be looked at with suspicion immediately. Very simple for stop loss techniques. If it opens here and trades higher, put your stop one tick below where it opened. If it comes back down through here, it's probably creating some sort of candlestick sell signal. In this case, the sell signal was a very strong bearish engulfing signal. Not only did it engulf the previous day's candle, but it breached the T-line, the 20-day, and the 50-day moving average, all ready to take it back down towards the 200. The bigger the signal, the higher the probability there's been a change of investor sentiment. The bigger the signal, the more compelling there's going to be a reversal. This is true with a bearish engulfing signal as well as any other of the candlestick signals. This chart had all the makings for a reversal. Notice a gap up in the overbought condition. Even though this may have been a J-hook pattern, the gap up should have kept at least an alert that this might be the last gasp up here. Then followed by a very strong selling. The first place to put a stop is one tick below where it opened the previous day, because logic just says if you're in the overbought area and they had enough selling pressure to bring you back down through the last bullish candle, that's not a very strong trend anymore. That tells you the bears have gotten control and you want to start going short. Now, this would have been a good case of the question, do you short from here or from this level? The more conservative you are, the higher the probabilities that you're going to be in the right trade at the right time. So the cost of doing business, giving up a little bit of profits right here, is probably much greater for producing a profitable trade when it closes below the T-line and then shows bearish confirmation the next day until we get down here to a morning star that we'll get to in later sessions. As with all candlestick signals, a bearish engulfing signal followed by a gap down is that much more compelling that there's been a reversal. The signal itself showing there's been a change of investor sentiment, the gap following that signal demonstrating that there's a strong force to that direction. As can be seen in this chart, they tried to take the price back up one more time after the first sell signals, and then they gapped it down through the T-line, which just gave very good evidence that not only had the investor sentiment changed, but now they were in a very strong urgency to get out of this position, creating a good long downtrend. Here's a bearish engulfing signal that occurred right on the 200-day moving average with stochastics rolling over. Note how the next day they actually did gap it down, take it down for a while, but brought it back up, but didn't do any type of signal. Then the following day they gapped it down again. So this was all evidence, again, that the sellers were anxious to get out of this position. Even when they tried to take it back up, the resistance area where the signal was formed also acted as resistance for the high trading of that day, and then they took it back down again. This is kind of a booster signal telling you not only could they not bring it up, but when they sold it off hard. Candlestick analysis provides opportunities to add as many elements as possible to make sure you're in a correct trade. Notice how this chart set up with a gap up in an overbought condition, indecisive trading, and then finally a doji followed by a bearish engulfing signal called a left-right combo, which is an extremely powerful reversal, closing right on the T-line and then gapping down with stochastics heading down. That was all the elements you could possibly imagine to show that the bears were now starting to take control and that your downtrend was going to be fairly extensive. Or as illustrated in this chart, again, a left-right combo right at the 50-day moving average, a gap up in the overbought condition told us to start looking for a sell signal, and a close back down below the 50 and right on the T-line. Made it very simple for the entry strategy the next day. If it opened lower, you shorted this position until you see a candlestick buy signal and a close above the T-line. This is not rocket science. This is just elements that the Japanese rice traders have observed for hundreds of years to show in the same graphic formations what is going on in investor sentiment, and realizing that investor sentiment does not change from year to year, decade to decade, or even century to century, that the human emotions are what move prices. Because we know exactly what's going on in investor sentiment based upon the signal formations, that helps us when we use resistance levels and show where there's a failure in a trend. It becomes fairly obvious that the bulls are in control right to the 200-day moving average. Then we start seeing the bears taking control, not letting the bulls get it up through the 200-day moving average. Notice how we've had little bearish signals in here, but it didn't become finalized until the big bearish engulfing signal that closed away from the 200 back below the T-line. Stochastics now heading down. One of the people had asked me in a training seminar not too long ago, how long does it take for you to confirm, or how many days does it take to confirm that the selling is occurring? And all it takes is a signal and confirmation the next day. The major advantage found in candlestick analysis is that the formations show you the type of sentiment that is occurring at specific technical levels. Notice this one traded right up to the 50-day moving average. Then notice the dojis, which represent indecisive trading days. It's showing us there isn't too much force left, and it didn't show there was a change in trend until we had a major sell signal or a left-right combination with a bearish engulfing signal closing back below the T-line. This is the information that we get immediately where other investors might be waiting for more days of confirmation that it has failed a technical level. The visual aspects of candlestick analysis allows an investor to see immediately what's happening. Had this been just a down day in an uptrend, that would have a completely different connotation versus a bearish engulfing signal at the top of a trend. This would tell us that we would want to be out of this trade immediately, especially if it opened lower the next day. Then a close below the T-line would tell us not only do we want to be out of this trade, but we probably want to be going short until we see a buy signal and a close above the T-line. A doji followed by a gap up is usually a very strong signal. However, if it's at the top of the trend, trend with stochastics now getting into the overbought condition, it's much more prudent to see whether they're going to be able to go through a major resistance level. The fact that they gapped it up right to this resistance level and then started selling it off was an immediate clue that they weren't going to take it through, that you start watching for that sell signal with a gap in the overbought condition. Once again, a failure of a resistance level and a close back below the T-line is a very good reason to go short until you see buy signals and a close above the T-line. And logically, what is your trend going to be if they fail at a major resistance level? That the bulls are giving up, and they will start coming out of a position faster and faster as they see that position did fail at a major support level. We also have the element of being able to see what they do at the next support level. In this case, a big candle that closed below the 200-day moving average, which told us they weren't supporting at the 200. There was probably more downside. The information built into the graphic elements of candlesticks give you a huge amount of information to make very accurate assessments of what's going on in a trend. A failure at a major resistance level works just as well as a failure of a pattern that we see in candlestick analysis. You will find that in learning candlestick trading, that a fry pan bottom has a very high probability of a breakout to the upside when it gets back to this level. But if we see a bearish engulfing signal at the area that it should be breaking out, we know immediately to be back out of this trade that it is not working. The signal gives us the information we need to tell us whether a pattern is working or not. And on the other side of our analysis, knowing the little patterns that are set up by candlestick signals produce extremely high probability reversal signals, such as our left-right combination. As described before, a left-right combination is a doji followed by a bearish engulfing signal. The doji acts as that little indecisive jab. The bearish engulfing signal acts as that big roundhouse right hook that takes out the enthusiasm of the uptrend. Look for lower trading after that. That will be as a confirmation of your downtrend. So very simply, you see a doji, especially a little gap up doji in the overbought condition, start looking for sell signals. The next day there's a doji, dragonfly doji. The following day we have a bearish engulfing signal that closes right on the T-line. This has given us information that the bears are now starting to take control after a couple indecisive trading days. How do we enter this trade? Very simply, if it trades below the close of the bearish engulfing signal, we want to be in it. It opens positive, makes this a very simple entry strategy. You put your sell stop one tick below the close of the previous day. Rationale says if they open it higher, but then come back down through the open of the previous or the close of the previous day's candle, that the bears are still in control and they're probably taking it down below the T-line, which in this case they did, which made a very good short. The left-right combination, whether it's bullish or bearish, is one of your strongest reversal signals. Whenever you see it, get ready to go short after a lower open the next day. As we can see in this chart, it popped up a little bit, but the information was built into this reversal right here, that this was where the bears were starting to take control. This chart shows a left-right combo followed by a lower doji. Also makes this a very simple trade, that if you didn't get in on this lower open, if it opened lower the next day, we have a doji sandwich, which means this trading day is going to be equivalent to this trading day right here. And if they sold it off that much after the open, that told you they were going to be closing us well below the T-line. That was definitely the time to be getting short for a good strong downtrend. A long-legged doji shows you there's indecision. The bearish engulfing signal right behind it tells you they've made their decision, and it's usually going to be a fairly strong one. The left-right combination is one of your most highly regarded or highly strength reversal signals. Whenever you see it, pay attention to it. And we'll show it again. Indecisive trading in the overbought area. A doji, bearish engulfing signal and a close below the T-line, and stochastics heading down. We were obviously showing this, repeating this signal because it is such a high probability reversal signal. And to quell the nervousness of trades, there's your left-right combo. That tells you the bears are probably taking control. They couldn't take it up to a new high. The next day, if you were shorting on weakness and it closed a little bit higher, many investors are going to be nervous. However, you've still got to regard this as a reversal, that the force is usually going to be in this direction. I say usually. You've got probably a 90% chance or greater that a left-right combination is going to start your downtrend. The factors in this signal, this left-right combo, make a entry strategy very simple. Left-right combo closing just below the T-line. If it opens lower the next day, you want to be shorting immediately. That tells you the bears are now in control. This is a very high probability, very simple entry strategy for being in the right direction at the right time. If you see a gap up doji in the overbought condition, start watching for a sell signal, especially if you've moved away from the T-line. Should you short before it gets to the T-line? Depending on the amount of space there is above the T-line that it's going to come back to, you can always short with the anticipation that once it gets to the T-line, if it shows strength, you can cover your short position. If it goes through, you're going to be in the downtrend. Once again, a left-right combo away from the T-line. Be ready to short it, especially if you start seeing it not being able to stay up above the T-line. The simple rules of candlestick analysis at least prepare you for getting ready to go the other way. A gap up in an overbought condition, gap up doji, and then notice what we've had for the next 4 days or 3 days. We have indecisive trading. Is this doing a J-hook and heading back up? When the bearish engulfing signal came in, that told us a very clear story that all this indecisive trading has now been told us which direction it's going to be going based on a very decisive bearish engulfing signal. A left-right combo with a big bearish engulfing signal. Always keep in mind, the bigger the signal is, the more compelling that the investor sentiment has changed. And to repeat again, the factors that we know about candlestick analysis greatly improve our probabilities of being in the right trade at the right time. A gap up in an overbought condition very simply tells us be prepared to take profits. They gap it open the next day. They've gapped it up again in an overbought condition. That gives you a couple parameters for taking profits. If it opens and trades higher, you put your stop right below where it opened. If it opens and starts trades down immediately, put your stop at the previous day's close. The rationale being that if they are able to bring it back down through the previous day's close, that means the bears are probably taking the trend control, and they're going to produce some sort of candlestick sell signal. And when we see that it's a bearish engulfing signal, we should now get prepared to be going short, especially after taking profits. Now we can take a look to see whether this is a good trade going the opposite direction. So left-right combo, get ready to go short. It's a powerful signal. Left-right combo after indecisive trading, that bearish engulfing signal gives you the demonstration of which way they're going as far as investor sentiment. If it opens lower the next day, you want to be shorting immediately. And candlestick signals illustrate when there's been a change of investor sentiment. A bearish engulfing signal with a booster is more factors that you can add in that there's been a change of investor sentiment. And the booster is that tail to the upside. Tells us the bulls are in control. And then all of a sudden, the bears took control and not only created a booster after a bearish engulfing signal, but that booster told you that even after they'd been bearish that day, they turned dramatically, that they'd been bullish that day, that they turned dramatically bearish and closed down lower. This little booster move tells us there's a lot more force going to the downside. And that booster pattern is going to give us an opportunity to take profits, as we mentioned before. If it opened on a gap up in an overbought condition and traded higher, you just put your stop one tick below where it opened, with the rationale being if it came back down through, is going to create some sort of candlestick sell signal. And that little change of direction and going this direction tells you there's going to be a lot more force, that uptrend is over. As with all candlestick signals, the T-line is a very important factor for demonstrating when a trend is going to be in progress. If nothing more, if you learn your candlestick signals and the use of the T-line, your trading abilities will become dramatically improved. A candlestick reversal signal and a close below the T-line allows an investor to know that the probabilities are extremely strong that once you have closed below the T-line, the trend is going to be in your favor until you see a candlestick buy signal and a close above the T-line. Now, does that mean that in this type of case, you might be covering a short position? Definitely. But it also tells you that you want to be right back into the short position after a candlestick potential sell signal, a doji, and a gap down back below the T-line. The T-line is a very important element, especially useful when a major sell signal occurs and closes below the T-line at the same time. A left-right combination closing below the T-line. Another bullish day. What does that do for our trade situation? If we'd gone short here, if this confirmed by trading higher, especially above the candle that told us the bears were in control, you close out the position. Or, since it closed more than halfway up this candle and above the T-line, you close out the position. However, part of learning how to trade successfully also has the element that you can be stopped out of a trade, but if the trade turns right back around and does what it's supposed to on the next bearish engulfing, you get right back in. Candlestick signals are a great deterrent for having your emotions involved in your trading. If you do the mechanics of candlestick signals, which are the illustration of what's going on in investor sentiment, you'll get past your ego of sometimes coming out of a position and having to go right back in it. A left-right combo, a good distance away from the T-line. That's the time to go short, even though you're still above the T-line, because where's the probability of the next move is back to test the T-line. At that point, if it showed strength and came back up, you could always cover your short position. If it stays below the T-line, you know your trade is going to be good. Even if you short it up here and cover it here, even on a bad trade, you may still make a little bit of a profit. The bearish engulfing signal makes it very clear when the bears started taking control. Indecisive trading, trying to move to the upside, a strong candle to the downside, engulfing the previous day's trading, a left-right combination, and a close below the T-line, also turning the stochastics over, told you the bulls were trying to take it up, but this is clear evidence where the bears were taking control. This is clear evidence that once the trade got to the resistance level of the 50, that a left-right combo told you that they weren't going through. The probabilities are extremely strong. They're taking it back down. To keep illustrating this setup, as you can see, this setup is not a random setup. That once they close below the T-line on a left-right combination, there's usually going to be a very strong downtrend. Bearish engulfing signal, closing below the T-line, strong downtrend. Bearish engulfing signal, closing right on the T-line, makes the entry strategy extremely simple. If it opens lower the next day, not only is it confirming the bearish engulfing signal, but it's also confirming that the T-line's not acting as support, that it's time to go short. This will also become evident that if you see a flat trading range, and then you start seeing bearish engulfing signals closing below the T-line, that at one point they're going to start breaking it. Here you might have gone short, covered the position. Gone short again, covered the position. Gone short again. The little losses that you may have taken in here will finally be gratified by a very big move to the downside, well covering the cost of doing business, the small losses. As a candlestick investor, this is what we really like to see. A left-right combo, a close right on the T-line, and they gap it down the next day. That's where you want to go short immediately. When you keep seeing this, the repetition today is so that you do not have to go out and be convinced that these signals and patterns work. After seeing them enough times, you'll be ready to move immediately on a gap down after a left-right combo or any bearish engulfing signal that closes right on the T-line. This helps take the emotions out of your trading in the fact that you already know what to do and what to expect after a candlestick combination signal. A lot of people have a hard time entering a trade. The more you see that trade works like it should, the easier it's going to be for executing your short positions. So let's take a quick review about the bearish engulfing signal. A left-right combination should always be ingrained in your mind as a very strong reversal, especially if they open it lower the next day and especially if they close it below the T-line. Your stochastics will indicate that it's starting to roll over. The investor sentiment is starting to change. Remember, with any candlestick signal, the bigger the signal, the more compelling your next downtrend is going to be moving in that direction. Also, with any candlestick signal, if you see it gap down after a bearish signal, that's that much more compelling reason to go short, because that tells you the bears are coming into that trend with great force. And that's the great force that we want to see to push our trade more to the downside. A combination of candlestick signals is going to tell you what's going on in investor sentiment. A bearish engulfing signal closing below the T-line. Not very decisive until we see another candlestick sell signal closing below the T-line. The more you see as far as bearish signals in a topping action, the higher the probability your downside is going to be fairly strong. The bearish engulfing signal seen at the end of a flat trading area is the signal that told you there's now letting the bears take control. That's when you want to definitely go short, especially when they gap it down. That tells you after a flat trading range that they've just told you which way they're going to start taking it after that indecisive trading area. And finally, the more elements you can put into a successful trade, the higher the probability that trade's going to be. A bearish engulfing signal, a good distance away from the T-line in the overbought area is giving you a high probability that they're at least going to come back to the T-line, and then you can see what it does at that level based upon the candlestick signals to see whether it's going to continue further. That brings us to the conclusion of our training on the bearish engulfing signal. As we have illustrated, the bearish engulfing signal has a very strong reversal pattern implication. The Japanese rice traders have pulled this one out as being one of the major signals. I hope the repetition nature of this training will allow you to visually recognize and understand where these signals work effectively. Thank you for watching.